This is the Money Seed Podcast, where we discuss all things investing, plain and simple, the way it should be. Please remember, this show is for educational and entertainment purposes only and is not intended to be investment advice. Welcome back to the Money Seed Podcast. Today we're talking to the fixed income GOAT, Nic DeAngelo. Nick, welcome to the show.
Gabe, excited to be here. Great catching up with you a little bit beforehand, and I'm looking forward to diving in.
Nick, I can't wait to get into it. We're going to talk about real estate, about how you built a $200 million plus portfolio, about economics, syndications, entrepreneurship, and a whole lot more. Let's start us off with that nickname. I love the nickname, the fixed income GOAT. Where did that come from?
Yeah, so, my background being in real estate for many years, we've done a lot of different investment types, a lot of different market conditions that we've operated in. And what we found consistently, we were getting these really high returns, really great projects, really off-market deals. What we found was by staying close to our investors and asking them what their needs were in the marketplace, we found consistently as they aged, that they were looking for more and more of a fixed income focus, right? Because there were opportunities on the market for high returns, appreciation, properties increasing in value, but those were 3, 5, 7, even 10-year lockup periods for a lot of these deals. And so we're starting to get, we get to work with some higher net worth individuals and, more on the, 8, 9-figure side, they're looking for fixed income that was backed by real estate. So we leaned into that heavily, and we had some products and some asset types that we had a lot of experience with that fit that criteria well for them. So we've leaned into that very aggressively in the last handful of years, especially with the market changes, especially with a lot of syndications, having disruptions where they're not making distributions. So what started off as us just trying to, fit the needs of a group of investors that were shifting towards, the baby boomer, the retirement, the post-retirement phase of their life, ended up being a massive focus for us. And now we have an entire income fund focused on that. So that's where the, fixed income GOAT came from, is just getting, me kind of getting a hard time from some of our investors, just being like, oh, this is a great opportunity right now. And really them twisting our arms to give them a product of fixed income.
Take us through how one of these funds is structured. I'm kind of curious how you generate a fixed income from a real estate backed portfolio. Usually when I hear the word fixed income, I'm thinking of a paycheck that arrives on a regular basis. It's a regular amount. I can kind of depend on it. Whereas real estate, the way a lot of people picture real estate is, maybe the cash flows aren't that consistent, or, hey, maybe there's a repair that was unplanned for. Now I won't get a check for a few months until I pay that one off. Or, hey, look, my tenant is not there anymore, so I won't have income for the next few months while I get a new tenant. But how do you generate a reliable and consistent income flow from real estate?
So you hit the nail on the head, Gabe, is real estate does have a degree of inconsistency. And so that's why I always laugh when it's like, oh, passive investing, right? And it's like being a landlord is never passive. It really is not. It's very hands-on. You have to be very close to the asset management side. You have to be very close to your investors and letting them know what's going on the portfolio, et cetera. And that's great for many investors that have a time horizon that matches, a higher return profile typically. I was just looking at some stats today. I think, I don't want to misquote this because it's a pretty big stat. It's something like out of the last 25 years, real estate has outperformed the stock market, 80% of the time, something like that. I'd have to tighten up that particular stat, but it's the massive performance that real estate can bring in the right market conditions. The issue comes with exactly what you said, where, a big capital expenditure, or you got to overhaul a building. We operate in industrial a lot on the syndication side. Those might be $5 million renovations of buildings. Right? Not a lot of people have that just sitting around. Not a lot of people can have the conversation of, hey, we're going to need 6 months, 8 months, 9 months to be renovating and releasing a property. So what we leaned into was the fixed income side of real estate, which is primarily debt related, right? And so some debt's shorter term in real estate, some debt's longer term. And our investors going into the retirement phases were like, we don't want disruptions in cash flow. The whole point of their focus was to have stabilized cash flow. So we just said, what's the most long-term outlook in real estate that you can find? and what's the most stabilized asset class that you can find over 10, 20, 30 years. And what we landed on pretty confidently was single family homes, right? So if you look at single family homes, the mortgages behind those are there's only one place in the world that does mortgages like the US does, and that's the US, because we have 30-year fixed rate mortgages in the residential world. It's unbelievable. So what we did on our side was said, hey, we think the fundamentals of single family housing are extremely solid. We think the fundamentals of the debt behind that, the mortgages, are extremely solid, and we can provide great returns over a long period of time with a high degree of certainty, higher than we were finding, most other places in the fixed income space. So on our side, we pay 12 to 14%, which is higher than the interest rate of most of those mortgages. So we're looking for discounts on those. Often we'll buy non-performing or underperforming mortgages. Many banks, their business model includes a focus on originating these loans and then packaging and selling them. So when they get these onesie twosie mortgages that don't pay, it's a huge hassle for them to do a one-off loan modification or a one-off this, because really they just want to package and sell it. So, Saint Investment Group, we step up and have conversations with big banks on those. We buy those usually in bulk, and work with the homeowners to get them back on track performing. It gives us the advantage of, getting those at a discount. It gives our investors the advantage of getting a fixed income opportunity that's above market, and it saves the homeowner. Really, the goal is to keep them in the house and make payments for a long period of time. So I really like that business model. I've been on the other side where we were buying foreclosures. I don't like that as much. You don't always go home feeling amazing about certain deals. There's a lot of legal headaches, but we found that this is kind of one of those win-win-win opportunities. So if we weren't getting the mortgages for a discount, we wouldn't be able to pay the distributions that we are, or the returns that we are. But we buy them from banks at a discount, and we're able to provide higher fixed income return on that basis.
Got it. And that makes sense. So you're not necessarily buying properties like single families, multifamilies. You're more in the hard money space where you're lending out money to investors, or you're just buying mortgages on the secondary market, and you own the debt essentially.
Correct, the latter. So, and we do own hard money loans, we private money or whatever, term people want to use today for it. But the primary focus is the long term, standard single family mortgages at, 4, 5, 6, 7% that are, 20 plus years left on that. Many times the borrower has high FICOs, it's owner occupied, so it's a family living there. They don't want to leave either. Maybe they had problems paying during COVID. Most of the time, they're great people that live in these homes, and they just need somebody to have a conversation and just slightly modify the loan to fit their current income situation, et cetera. And so a lot of times it's just getting on the phone with good people and saying, how can we help you? Why aren't you paying? What can we do to, build in a payment plan or reduce your monthly payment if that means extending the term of the loan? So a lot of times it's pleasant discussions more than a lot of like heated or negative discussions. So we found it's a good mix for what we're good at. We're good buyers. We're good at relationships with sellers like big banks. I have a background on that on the acquisition side. So it just fit nicely with what our investors were looking at on one side, our skill set on the other, and then kind of a longer term outlook. We dig into economics quite a bit. I mean, just even in the last few weeks, whether it's the stock market or the Federal Reserve and all this new information coming out, things are turbulent at times. So if we can provide a degree of stability, then, it's something people can invest in over the long term and look to other investments as well if they want to balance out their portfolio.
And I imagine if you have a fund with, dozens of these loans in there, even if one of them performs, but the other 20, 30 keep performing, that's where you get the consistency in the money coming in every month. So, I mean, I love the model, and I think it's amazing that you guys are able to generate, if I heard you correctly, over 10% or above 10% returns, which is pretty
Correct.
amazing.
Yeah. Our highest share class, our highest structure is 14.28% returns. So, and that's a longer term. That's a 3-year hold for the initial term, and then we return money in 90 days after that when someone, they can keep it rolling over a longer period of time or get their redemption, et cetera. But We like that flexibility, shorter term, 3 years as opposed to 5 or 10 years for many funds. And it gives, we have terms as short as 6 months for investors. The return's lower, right? But it's some flexibility, and it gives the investor more of an active role in choosing how they plan their portfolio.
How did you get into real estate? Now, if I heard you correctly, you have something like close to 2 decades of real estate experience. I'm always amazed at how people get started. Sometimes people get started in the easiest and simplest and most innocent ways. And here you are today running a $200 million portfolio. But what was your first deal and how did you get into the space?
So I had my eye on real estate early on. I'm blessed to have been around entrepreneurs, like an amazing entrepreneurial family that, they really kind of always stepped into businesses as, founders. And these most weren't massive businesses, although there were a couple very big ones that were very impressive. But most of the time, you look at like grandparents that are, you know, um, doing smaller businesses locally, et cetera. So that I kind of had that in the back of my mind. And then I just saw that so many successful people were in real estate. I mean, I wish that there was something more advanced than that, but it was just, let's pull that thread and let's figure out what that looks like. And my earliest foray into real estate was approaching a friend of the family and saying, hey, can I do some marketing for you? Right. There's this thing called the internet. Right. And so I'm in the air, I'm a millennial. So it's that transition from fax machines and paperback, marketing materials to the internet. So there's a lot of opportunity and people did this in other sectors. I just borrowed their idea of, hey, can we get you up to speed by marketing online? Right. And so I was like, well, these freaking real estate guys are killing it. But real estate at the highest levels is technology, advanced forward thinking on the technology side. Back then it wasn't. It was very behind. So I was a young kid, I was in my teens, and I was just like, hey, if I put this on, marketing platforms, will you give me $100 a deal? And I thought I was like killing it at $100 a close. Eventually graduated college, and I said, I really like this. I made a few bucks doing it, just close enough to learn some things, and some of them on the marketing side. And I actually approached a family office, small, right? Not New York, not billions under management, but 3 generations, right? So family planning, multiple generational hand downs of real estate and rebalancing of portfolios, and I just wanted to be close to it. So I negotiated to work for free. They originally wouldn't even hire me for free. And I just said, well, hey, if I can make you some money and it doesn't cost you anything, can I just have a seat? Can you find a desk for me? And it was in the wake of the 2008 crisis. Revenues were slim, so that was kind of the hot ticket, was to make people money, and that's what got you a seat at the table, which arguably that's always the case, right? If you can drive revenue for a company, you are somebody that's in demand. And so they gave me a seat. They let me have a desk. I got to work directly with the CEO and that generation's CEO of that family office. I learned way, like, infinite amounts. He could have never paid me what I actually got in education. And from there, we really took off and started buying quite a bit.
That's amazing, man. Good for you. Like, so it sounds like you went to them and said, hey, I'll work for free. Let me learn what you guys do. Let me learn what you're all about. And it sounds like you got a good deal out of it.
Well, they said no is really the next step. They said absolutely not. We can't afford you at free, because you look at a really high net worth, really successful individual, their time. I mean, you might be thousands of dollars an hour, right? So he's like, how much time do you think I got for you? And I was like, oh, I got slapped in the face over this, right? So I brought a list of 500 people that were interested in buying, and I said, hey, you have brokers on staff, whether they're salary or not. They will do these deals and they will make you money by doing these deals. And, and also I was bugging the crap out of him constantly for a job. So between all that, he was like, yeah, 500 people, at least some of these guys are going to transact. I said, hey, that should pay for whatever time, we interact, and I can help you out during that period of time. So that's kind of what got us in. And then the next was like, well, what are you going to do next? How are you going to make us money next? Right. So I pushed into acquisitions pretty heavily. It was, again, the wake of 2008. So there's a huge foreclosure boom, huge opportunity to buy things at discount. There was just no freaking money. right? Which sounds weird, Gabe. You know the real estate market. The last 10 years or so, there's been too much money. Everyone's now chasing yield, or was at that period of time. But in the post 2008 area, 10, 11, 12, even up to maybe even 14, there was a cash crunch. It was hard to get financing for deals. So we had tons of ridiculously great deals. We put together good investors, worked with great people, and still, I mean, those are some of the best deals we've ever seen still to this day. So market timing's huge. The economics are huge.
I believe that you have an economics background. Tell us more about your economic theories. I love the fact that you say Wall Street is broken and economics tells the future. So tell us, how do you combine your economics knowledge and your knowledge of real estate to create really amazing products for your clients?
So I think, yeah, and I don't have a crystal ball. You're always supposed to say that. And we, past performance doesn't include, future, blah, blah, blah predictions. But all that to be said, we all make bets on what the market looks like, right? The Federal Reserve can come out tomorrow and they're going to tell us what market we're stepping into, right? There's wheels that turn that are bigger than us, but economics gives us a pretty dramatic view of the underlying forces that we're stepping into as investors. So one of the biggest lumps that we've ever taken was, we had this deal, we bought it maybe almost 60% off, right? How do you mess up a deal that's 50? I think it was about 55% below a market value. Ridiculously good purchase price. The issue was, and we learned this very early, the leasing situation in the local market was a disaster. So it was a homeless crisis situation before there was a homeless crisis all over California. Now that's all properties, or there's a lot of properties throughout the state, many other parts of the country. But then there's a homeless issue. There was a, low employment issue. There's all these things that even the seasoned investors that were way ahead of me, my job was finding deals. Their job was analyzing, underwriting, and doing this. And we missed a number of things because we didn't have an airtight acquisition strategy. So we got out of that deal. We made great returns on that deal, but it was by really working our tails off on an extremely advanced leasing strategy, working with government agencies to lease spaces, working with huge, like 9-month, concessions. It was very, very complex. And at the end, I was like, this was a nightmare. This was terrible. What happened here? And so the post-mortem of the deal was very clear that we missed some of the economic forces behind it. And I was like, we're never doing this again, right? If I have to roll up my sleeves and build out what the evaluation and the underwriting looks like, then I'll do it myself. And I was still a young guy. And so I really, really, really leaned into the economics of the markets that we're looking at. We're never going to make the same mistake twice. And so now where we're looking, we have had a great track record by making sure we understand local economics, national economics, the monetary policy we're stepping into with deals. So what that looks like today on a broader scale is we're looking at kind of big trends. Because if you look at the news style of the US, we're talking about what happened today, last week, maybe, right? But the news cycle is very short in the US. It's really flashy. It's the biggest, craziest news that we can talk about, right? So it's huge. Oh, the market tanked X%, and this CEO got fired and went to this company. And it's almost like, we're dealing with like drama in the markets instead of really the big questions of what are the biggest drivers. So we tried to step away from that and get a little bit more like Warren Buffett, Charlie Munger, like 10, 20 year forecasting tools and strategies. So that's what we look at today, right? And so today I know that the biggest things that we see on the horizon are going to be inflation, right? We've all talked about it. We've all seen it. Oh, they congratulate when they're only above, targets by a huge amount, but not as big as they were. Everyone's, high-fiving and handshaking. But the bigger trends of that, very alarming from what we're seeing. We're looking at big trends like generational shifts. So it's, behind the scenes right now, we're looking at the biggest wealth transfer in the history of the world, let alone the US. We're seeing that in the background, shifting the investment landscape quite a bit. We're seeing, like you said, the stock market. One stat that blows me away on the stock market, where we sit today in the US, is since 95 till today. So since 1995 to today, the stock market has reduced the number of companies by over 40%.
Really?
Right?
Wow.
Just just the company count. So if you look at these changes, these huge changes that are occurring in the investment landscape, the monetary policy, economics at a broader scale in the US, big shifts are happening and most people are not tracking them and asking the question of what does that mean for investing in the next 10 to 20 years.
Yeah, Nick, and I'd love to get into some of those. Obviously, you don't have a crystal ball like you mentioned, and none of this is financial advice. But let's say your thesis on inflation is correct, and inflation is here to stay. Like the monetary supply keeps getting inflated at ridiculous numbers at a very fast pace. How does that impact real estate? And how should that impact my decision whether or not to invest in real estate and how to invest in real estate?
So that's the big question. Whatever we talk about, the real question is, so what do you do about it, right? So what does that mean? Like, what are the next steps? The drivers that we see, inflation being higher, you can scale all the way back to 2020. Since 2020 to today, over 80% of every US dollar in history has been printed, right?
Yeah.
So pre-2020, a couple hundred years, we had 20% of every dollar. Since 2020, just the last handful of years, it's over 80% of every dollar in history has been created. So that's one huge driver. I think that I'm shooting from the hip a little bit, but I think the numbers are that pre-2020 or at 2020 we had 4 trillion in circulation. I think it's over 20 trillion in US dollars circulated today. So just the circulation's up almost 400% of dollars in the system. You look at mortgage prices just since 2020 have gone up over 111% increase in mortgage payments. So all those things are happening in the background. And we could say, yes, COVID, right? Yes, supply chain issues. Yes, all those things are very real. Yes, we overprinted massively to a degree that we're paying for today. But there's also the big shifts under, kind of under the scope of what most people are looking at, like the baby boomers transitioning out of the workplace, some passing. Also, there's a shift of wealth. Baby boomer generation being the biggest generation that we've ever had in the US and the most wealthy by a very wide margin. And them passing on, the conservative estimate is $68 trillion that the baby boomers are passing on over the next 10 to 20 years. The more aggressive is like 75 trillion that they're passing along.
And
so you look at,
and I was going to say, if you had to estimate when you say like 65 or 75 trillion and they're passing it on, how much of that is going to go to the government in the form of taxes? How much is that going to like the next generation? What does that look like?
So here's some breakdowns for you, because that's a great question of where the money lands. The 68 trillion that I'm quoting lands in the next generation's pockets. That's what it's looking at. There's also 12 trillion in there that's immediately going to charities upon the passing of the giver, right? And so charities, huge windfall over the next decade or so. That's great, right? That's great. But it's really that question of that 68 to 75 trillion that lands in the Gen X and the millennials' hands, and how they see fit to spend that money over their period of time, because people shift what they view, right? So very inflationary, first off, that much money recirculating back into, the country and the world. And then the other question is, well, what are some averages? What are some numbers that go into that? So if you take the younger generations, Gen X and millennials, about 60% of Gen X and millennials will receive some degree of inheritance from the boomer generation passing, right? The average number, so those 60% of the US, the average number that 60% each person will inherit is about 275 to 300,000. Those are big numbers for the average person, right? Those are big numbers for the average family. That changes life quite a bit. And Gabe, we're in a consumer-driven economy, right? So if somebody wakes up with 300 grand, they can be really prudent and put that money into investments. And they should. That's what I would do. But they're also consumers, and we have generations of consumerism. So a lot of that goes directly back into the economy and kind of spins that hamster wheel of inflation further. So you asked the question of, what's real estate look like over that period of time? So two things is, I would say that you got to figure out what you do with the money and what people will do with the money during that period of time, and what those generations value as far as their investments. The stock market has bigger concerns right now. You're looking at Investor Business Daily saying people should reduce their stock holdings by 20 to 40% right now, like in the midst of all the stuff that's been coming up and monetary policy. And as simultaneously, you look at Gen X and millennial values, they value real estate very highly. So there's an estimate that percentage basis of a portfolio. So if somebody held around 10% real estate in the past, the estimates right now are that that could increase 3 to 5x. So the net worth of, let's say, a millennial could be about, instead of 5 to 10% real estate, could be 20 to 30 to 50% in real estate,
Yeah.
depending on which averages you're looking at. So to your question, to answer your question of what happens to real estate, I think real estate is not just a hedge against the inflation ahead, against the inflationary environment ahead, but it's also something that's viewed even more highly in future generations. So I see this as one of the biggest opportunities to be in real estate. Really, like, this is threading the needle right now before more of that money comes in down the pipeline.
And I think some of that will happen naturally, right? That increase, because in the past, houses were more affordable, right? So a family of four, their house was worth, like, let's say $200,000. That may have been 10% of a family's $2 million net worth when the parents reached their mid 60s. Whereas now, somebody's trying to buy a comfortable house for their family of four, they might have to fork out $500,000 or something, and so that's naturally going to take up a bigger chunk of their net worth. And you're right, I think people are looking at real estate a lot more seriously now than in the past as well. The other thing is, if inflation holds up, and again, this is not financial advice, but if inflation holds up, then maybe holding debt is not a bad thing to have, right? People talk about
Yeah.
good debt and bad debt. If you have good debt, if that debt is backed by assets that are going up, then that debt is going to be easier and easier to repay in the future, because inflation is actually kind of like eroding that debt away. So it's not a bad idea to have a whole bunch of investment properties all leveraged responsibly, with some mortgage debt, because 10, 20 years out, that mortgage is going to look really small.
Absolutely. Absolutely. And if you think about the fact that, one of the reasons that we like single family mortgages in this environment is, and real estate in general, is that real estate often raises with inflation. The value of real estate, that inflation, either than lockstep, or oftentimes real estate even, the value increases beyond what the inflation numbers are, right? So for us, we like the debt space because the debt that's being paid back is supported by real estate that's only increasing in value, typically in inflationary environments. So the likelihood of them not paying their debt back, the borrowers, the homeowners, is ongoingly going down, right? Like, on an ongoing basis, their likelihood is increasing. They're going to make their monthly payments, right? So their equity is increasing, right? Their, hopefully their incomes are going up. Hopefully household income increases along the inflationary curve also, which just makes that fixed mortgage payment easier and easier to pay back, and more painful with how much equity that they would not risk on their payments too.
So you mentioned inflation, you mentioned the transfer of wealth from the boomers to the next generation. Any other big 10, 20-year time frame economic trends that you're keeping your eye on?
That's a great question. One of them is work from home. I have my eye on work from home also, because it's such an interesting trend in the US especially, and it's complex when we look at like a global setting of the work from home environment. So the early discussion on work from home was, well, if I can work from home from Idaho but have a California job or a Bay Area job, I can make that San Francisco income my house, right? And what we found was a few different things, and that we've seen so far, and it's still evolving. But what we saw early on was that was the case. That was the case. You hire somebody from the Bay Area. They have the skill set of working in the Bay Area, but they get the benefit of living in Idaho and having that discount that, for their daily, expenditure. The issue that we started seeing coming up, and I'm still have a close eye on this, is that employers looked at it and said, well, work from home, does that have to be in the US, or is it all homes, right? Is it all homes in the whole world, right? And so the labor market got really complex, because you started seeing this huge boom of, offshore labor coming in. And historically it was like, yeah, that fills in the gaps for like the unskilled stuff or the low skilled stuff. But then what happened was, you have people on even Upwork that have master's degrees in accounting for $800 a month, right? Or these fantastic, marketers or fantastic systems people or fantastic technology backgrounds that are from other countries, whether it's, Eastern Europe or whether it's Southeast Asia and the Philippines or even, Latin America. And these are extremely competitive in the marketplace with their skill sets, maybe 80% off, right?
Yep.
That's complex. Now, there's advantages to being in the office. There's also advantages to not having huge office bills for companies. So that's a balancing factor. The current number, I want to make sure I get this right. I'm kind of pulling up some stats on it that I have noted. The current number is, I think it's back to 26% of employment is work from home. That went up to 55%, I think, during COVID. Like, it was the majority of people were working from home. No question there. It was during a pandemic, a global pandemic. So nobody wanted to be in the office. But after the pandemic, it went down to 37%, extended period of time, like 2022. And then now it's back down to that 26% range. So I'm keeping an eye on that because, real estate, huge driver is where people are, right? Where the jobs are, because people got to stay local to their job to be in office if that's their setup. So those trends, the movement, of employment, of where people are living, that's huge drivers for multifamily. That's huge drivers for industrial. That's huge drivers, especially for office, right? So because that touches so many sectors, really all of real estate, I have a big eye on work from home so that we are ahead of whatever those trends look like. Maybe it's emerging cities, maybe it's cities on, with a little bit of a sunset of their best days, but trying to understand which markets are on the up and coming that have a lot of opportunity.
Yeah, and I imagine that if 26% of all work is remote, that means 26% of workers are going to be looking for an extra room in their house when they move or when they build their next house. Because, I do some work from home as well. Like, actually right now, I do have to go to the office like 2 days a week, but the other 3 days I'm at home. And I tell you, man, like, you can't just do it out of your bedroom. Like, you actually need a dedicated space if you're going to work from home. Um, Before we wrap this up, Nic, tell me more about some of the other stuff you're doing in the syndication space. I recently heard that you are doing some industrial real estate syndications, and you've seen amazing returns, like eye-popping returns, north of 30%. Tell us more.
We focus. Our goal is always to be hyper focused, right? And so on the fixed income side, we basically, our number one focus is going to be single family mortgages. On the syndication side, it's industrial without a question. And the reason for that is we've done 5, 6 asset classes across the different portfolio over the period of time. Everything from retail, we've done office, mixed use, we've done specialty, and really the number one asset class that we operate best in is industrial. There's a few reasons. One is we like the leasing structure of industrial. We like the construction type, and the drivers of industrial are very complex for most operators. So we feel very comfortable in that. The barriers to entry are very high. There's lots of zeros behind each property. I love that too. I like, if we're going to work hard on a deal, I'd rather there be another zero or two, right? So we've gotten great returns. A big part of that was market timing, right? But the market gives and the market takes. So we had these ridiculously high returns in the COVID era and pre-COVID era. We did very well on acquisitions. So we bought low. So there's a lot of room for upside on that. But during the COVID era, there's this huge shift away from office and retail. Retail's bounced back. The retail apocalypse, I believe, is over. But I mean, office is a whole different ballgame. People, 26% of people working from home, Gabe, that's a massive increase from pre-COVID of being about 8% of people working from home. So how much more Amazon do you get or do I get today than we did before that? So industrial warehousing is our sweet spot. We are hyper focused on just a couple markets. We are hyper focused on really only 2 acquisition models. And we're also hyper focused on timing in the market, because industrial is this weird asset class where, arguably multifamily might be a good time to buy right now. I'm not a multifamily pro, so I won't give my opinion and exact advice on exact markets. But what I can tell you is multifamily has the advantage. If you buy low at a good timing in the market, you can ride the leases up in value. right? So as leases increase, if you have 400 units, each time they turn over, you can slowly absorb that increase. Industrial, what we look at, which is single tenant, triple net industrial buildings with usually it's 9-figure a year companies, national credit or global credit companies. They have one lease for one tenant in one building. So if you time that lease wrong, you're below market for 5 years, right? So in industrial, if you're too early, it's the same as being completely wrong because your return profile is going to be way off. So right now, I don't, and again, I say this with the most love in my heart for industrial out of any hard asset class, but we are analyzing deals, but we haven't purchased in 2 years for industrial. And we're seeing in the next probably 6 to 12 months that it's going to be the perfect entry point for us. But the reason we love industrial so much is because we know our drivers and where we add the most value and what fits our profile so well. And we only buy within that buy box. So we've had great returns. We've had a lot of upside on deals that have been great, but we're also super freaking picky. That might mean 3-4 deals in a year. And then like right now, it might mean no deals for 2 years. You know what I mean?
You are the CEO and founder of Saint Investment Group. Tell us more about the company. How'd you get the name? What's the team size? And where can people find out more information about it?
Like you were saying, we have a lot of team kind of across the country. We're right about 22 in team right now. So we have a great team. The background was acquisitions. We started on the acquisition side, buying off market, buying very aggressive, buying great price deals. Eventually, we bought too many deals with our partners that we were working with, and the asset management kind of swelled beyond what we're saying. Hey, the performance has dropped slightly on some of these. We got asked to come on board and handle asset management too. So started in acquisitions, added on asset management. That's when we founded Saint, was as the asset manager of all those assets. So it was driving performance. Again, it's very lease heavy. It's very acquisition heavy on driving our performance numbers. And then we, started bringing in new investors and kind of more outside investors about 5 years ago, and maybe a little more, and about 8 years ago, 7 years ago. And, now we have our income fund that's humming along. And kind of the next goal is to continue growing the income fund with great investors and doing those above market fixed income returns. And then we'll introduce syndications in the next 6 to 12 months. And that's kind of the outlook as we see it today in the market.
Love it. What's the best way to get a hold of you and to contact Saint Investment Corp?
We give all of our economic data away for free. We give all of it away as just free education. We find that the best investors know the most that they possibly can about the market, and they see really understand what we're doing and kind of the fine details. So we give it all away for free at saintinvestment.com/resources. And we host webinars. We just did the greatest wealth transfer in history webinar, where we went through, in detail about an hour-long webinar. We're doing those every couple of weeks. So I encourage people to check those out and get some good education and some good breakdowns of economics and investment strategies.
Love it. Nic DeAngelo, the fixed income GOAT. Thank you very much for your time today. Really enjoyed talking to you.
Gabe, had a lot of fun, man. Looking forward to catching up next time.
Love it. Hey, thanks for joining us for another episode of the Money Seat Podcast. Please remember to click like and subscribe. It really helps spread the message to other investors, and it helps attract new viewers to the show. We appreciate your support. Thanks very much.